can feel like you're constantly playing catch up, trying to stay on top of everything happening in the financial world these days, right?
Right.
It seems like things are changing so fast.
Yeah, absolutely.
So we're doing a deep dive today to help cut through all the noise and really get a grip on some of the major changes happening that are affecting how we all manage our money and even how we think about saving.
Right on the money.
Specifically, we're going to be looking at the evolving landscape of bank deposits.
That's right.
And to guide us on this journey, we've got this really interesting report called The Future of Deposits 2025.
Yeah.
And it pulls together a bunch of insights from Mambu, who are really at the forefront of banking technology,
Mm-hmm.
along with their own proprietary research and conversations they've had with experts at major firms like Deloitte and Time and Santander Group.
A lot of really smart folks.
So we've got a lot of ground to cover.
Huh.
But our mission is to extract the most important information from this report about the forces that are reshaping bank deposits, the challenges and opportunities this creates for the traditional banks that we're all familiar with, as well as the newer fintech players.
Right.
And most importantly, what all of this means for you as someone who uses financial services every day.
That's right, because it affects all of us.
To give you a little taste of what we're going to be talking about, there are some pretty intriguing things in this report.
Yeah, like what?
For instance, we'll be looking at how a fintech company like Revolut can have a market valuation similar to a giant bank like Barclays, even though they hold far fewer deposits.
Oh, wow. Yeah.
And we're going to unpack this thing they're calling the perfect storm that's impacting the profitability of banks
Uh-huh.
and explore the battle that's heating up to become your primary bank account.
This should be interesting.
So let's dive right into this idea of a perfect storm.
Okay.
It seems kind of strange at first because, we see reports of banks doing quite well recently, reporting healthy profits. But this report is pointing to a real shift in how the market views the long-term prospects of traditional banks, with their valuations being lower compared to many of these newer, more agile fintech companies.
Right.
So why is there this disconnect between current performance and how the market seems to be valuing them for the future?
Well, you hit the nail on the head there. It's all about how the market is looking ahead. While banks may be seeing profits now, the market seems to be really putting its faith and its money into the potential growth and the scalability that many of these fintech companies represent.
I see.
And, fintechs often have lower operating costs. And the belief is that they're better positioned to adapt to the changes that are coming down the line
Right.
and to capture the customers of the future, even if their current deposit base is smaller.
So it's almost like the market is putting more emphasis on future possibilities than on current assets.
That's a good way to put it.
Now, this kind of ties into the report's discussion of a deposit chain reaction
Mhm.
that can be triggered by changes in interest rates.
Okay.
Can you break down how that works?
Sure. As interest rates go up or down, it has a big influence on where people decide to keep their money right. So when interest rates rise, people are more likely to move their funds from those low-interest checking accounts to places where they can get a higher yield, like savings accounts that are offering a better return, or maybe they even start looking at alternative investments altogether.
Right.
And this outflow of deposits from traditional checking accounts can actually end up increasing the cost of funding for banks,
Oh, I see.
which of course can then impact their profitability and create this ripple effect throughout the entire financial system.
Like a chain reaction.
Exactly.
So apart from interest rates, what are some of the other factors that are contributing to this perfect storm that the report describes as putting downward pressure on banking sector profits?
Well, one major factor is the emergence of Generation Z.
Right. Those digital natives.
That's them.
Yeah.
They're entering the workforce now, and they have grown up in a completely different world than previous generations, a world where digital technology is just a part of everyday life.
That's true.
And so their expectations and habits when it comes to managing their finances are completely different.
I guess they've never known a world without smartphones and instant access to information.
Exactly. And they're much more comfortable with those non-traditional financial tools like, mobile payment apps and online platforms.
Okay, so Gen Z is one factor.
Right. And then another is the rising demand for yield on deposits. After a long period of very low interest rates, people are starting to expect more bang for their buck when it comes to their savings.
Makes sense.
And this is forcing banks to offer more competitive rates on deposits, which, as we've discussed, can squeeze their profit margins.
So they're kind of caught in a bind.
They are. And then the third factor is the mainstreaming of alternative payment methods and digital wallets.
Yeah, it seems like everyone's using those now.
It really is becoming the norm. People are finding it so much more convenient to transact and even manage their money through apps and digital platforms.
Uh-huh.
And in many cases, they're doing this without even needing a traditional checking account.
Like when you just tap your phone to pay for something.
Exactly.
Mhm.
Or, using apps like Venmo or Apple Pay to send money to friends.
Right.
And then the final piece of this perfect storm is the rapid growth of those global fintechs and what we call
The
neobanks.
ones that are digital first.
Yes. They have the advantage of being able to attract customers very quickly across borders, often without facing the same regulatory hurdles or needing to invest in a lot of physical infrastructure like branches that traditional banks have.
So they're much more nimble.
Exactly.
And the report highlights a pretty significant trend here.
Okay, what's that?
It points out that deposit levels in North America actually started falling in 2022.
Oh, wow.
After a decade of growth, and then over in the Eurozone, they experienced their worst deposit performance since the early 2000s, just last year in 2023.
That's a real turning point.
It is. It seems like things are really shifting.
It does seem that way.
And this trend really contrasts with the increasing use of those digital payment methods that we were just talking about.
Yeah.
The report says that nearly 3/4 of adults in the U.S. in 2023 consider digital payments to be their primary way of paying for things.
So the way people are interacting with money is changing dramatically.
It is. It seems like the competition for our money is really heating up.
It is.
And a big part of that competition is coming from these digital-first companies that are often cloud native.
Right, meaning their whole operation is designed to run online.
Exactly. And they can acquire customers at an incredible pace and operate across borders much more easily.
They're definitely changing the game.
The report uses this really striking example.
What's that?
They point out that Revolut has a market valuation that's comparable to Barclays, despite the fact that Barclays holds deposits that are almost 20 times larger.
Wow, that's pretty wild.
It is.
Mm.
What do you think this tells us about how the market is evaluating these different types of financial institutions?
I think it really shows that the market is looking beyond just the current size of a company's deposits. They're factoring in things like growth potential, the strength of their technology platform,
Okay.
and their ability to attract and keep those new customer segments that we were talking about, especially Gen Z.
Right.
So it seems like they're placing a higher value on the potential of that digitally native model and its ability to expand quickly, even more so than a large base of existing assets.
So essentially, they're betting on the future.
Exactly.
It sounds like this perfect storm that we've been talking about is especially challenging for those mid-sized banks.
How so?
Well, they might not have the agility of the smaller fintech company
Oh,
or the really deep pockets of those massive traditional institutions to really keep up with all of this technological change.
right. They're kind of stuck in the middle.
Exactly. They're facing the limitations of older technology systems without the scale or the flexibility of either the really big players or the new kids on the block.
That's a tough spot to be in.
It is. They need to innovate quickly, but they might not have the resources or the right infrastructure to do it effectively.
It's a real dilemma.
Now, the report does point out that traditional banks aren't just sitting still.
Oh, really?
They are becoming more agile in some ways.
Like how?
Well, for example, they're investing in data analytics to help them with deposit pricing.
Oh, interesting.
And that seems to have played a role in their recent profitability.
So they're using data to understand their customers better.
Right, and to offer more tailored interest rates to try to hold on to those deposits.
Okay, I see.
But the report makes it clear that this is not a long-term solution.
It's more of a Band-Aid.
Right. They really need to continue innovating. And perhaps most importantly, they need to modernize those underlying technology systems that are often decades old.
Right, those legacy systems.
Exactly. Some of them are still running on really old programming languages, and they're just not built for the kind of speed and flexibility that's needed in today's world.
I can see how that would be a problem.
It is. So let's dig a little deeper into these legacy IT systems.
Okay.
The report identifies them as a major hurdle for a lot of banks. Can you give us a clearer picture of the specific limitations that they impose?
Sure. These are often outdated IT infrastructures that were really designed for a completely different era of banking.
Right.
And they create all sorts of problems. They make it really hard for banks to scale up their operations quickly, to handle a rapid influx of new customers,
Nice.
or to roll out new services efficiently. They also slow down the integration of new technologies because trying to connect these modern systems with the old ones is incredibly complex and time-consuming and expensive.
It's like trying to fit a square peg in a round hole.
It is. And this often leads to integration problems and a continued reliance on those manual processes that we were talking about.
Oh, I see.
And another big problem is that there's often a shortage of expertise because the people who really understand these older systems are retiring.
Oh, that makes sense.
So you've got this kind of knowledge gap.
It's almost like trying to run the latest software on a really old computer.
That's a great analogy. It might work for a while, but it's going to be slow and inefficient. And eventually, it's just not going to be compatible with the newer innovations that are coming out.
It's like trying to watch a 4K movie on a dial-up connection.
Exactly. You're just not going to get the full experience.
Now, the report emphasizes that with AI and autonomous banking becoming more and more important,
Right.
the need to replace these outdated core systems is becoming even more urgent.
Absolutely. You just can't effectively use these advanced technologies with that kind of aging and inflexible infrastructure.
It's like trying to build a skyscraper on a foundation of sand.
You need a solid base to build upon.
And these fintech companies often have that advantage because they're using what are called cloud-native core banking solutions.
Right.
So their core technology is designed to run on those internet-based servers, which gives them much greater flexibility and scalability.
Exactly.
The report points to the impressive growth of alternative banks globally.
Uh-huh.
For example, they mentioned China's WeBank, which has more than double the customer base of Spain's Santander.
Wow. That's a huge difference.
It is. And it really illustrates the potential for rapid scaling in this digital realm.
It does. It shows how quickly these new digitally focused institutions can expand and bring in those new customers.
And it underscores the competitive pressures that the traditional banks are facing.
Absolutely.
It's not just about competing on price anymore.
Right.
It's about the overall experience, the ease of use, the quality of the customer interactions.
It's about meeting those rising customer expectations that we talked about.
Exactly. Customers now expect that same level of convenience and customization from their banks that they get from all the other digital services they use every day.
And rightfully so.
Right? It's like if you can order food and get a ride with a few taps on your phone, you should be able to manage your money just as easily.
Absolutely.
And the report makes it clear that delaying the modernization of these legacy technology stacks isn't just about missing out on innovation.
Right.
It's about risking customer dissatisfaction and ultimately losing those customers to the competitors who can deliver that better experience.
And the longer they wait, the bigger the problem becomes.
Exactly. So let's shift gears a bit and talk about this battle for account primacy.
Okay.
The report suggests that the growth story for these alternative deposit and banking providers is really just getting started.
I can see why they'd say that.
And it's largely being fueled by the increasing popularity of these alternative payment methods that we've been talking about.
Right.
As people become more and more comfortable using digital wallets and other non-traditional ways to pay for their everyday purchases, it naturally opens the door for these providers to start offering a wider range of financial services,
I see.
including things like deposit accounts and checking facilities.
So they can become more of a one-stop shop for all your financial needs.
Exactly, and potentially position themselves as the central hub for managing your entire financial life.
It's a brilliant strategy.
The research that's highlighted in this report is really eye-opening.
What does it say?
Well, it's found that nearly 2/3 of consumers in the U.S. were using digital wallets as often as traditional methods.
Oh, wow.
And over half of them said they actually preferred using digital wallets.
That's a pretty significant shift.
It is.
Yeah.
It really shows how people's behavior is changing.
And this shift is directly contributing to the rapid growth of these neobanks.
Right.
The report actually projects that neobanks are going to grow at a rate that's 10 times faster than the traditional banking sector over the next few years.
10 times faster. That's a huge difference.
It is. And it really highlights the momentum that these digital-first players have.
And we're seeing real-world evidence of this.
Like what?
Well, Revolut reported a 68% increase in the number of customers who are using them as their primary bank account just in the past year.
That's impressive.
It is. It seems like they're really capturing that core customer relationship.
They are. And while traditional banks have shown that they can adapt to some degree, like with their use of data analytics for deposit pricing,
Hmm.
the underlying trends of increasing digital adoption and those rising customer expectations that we talked about are definitely working in favor of the companies that have these more modern and adaptable technology infrastructures.
So the battle for that primary account status is only going to get more intense.
You can bet on that.
This brings us to this idea of a value reset that the report talks about, which is being driven by changing demographics and global opportunities.
Okay.
The report really emphasizes how changing customer expectations, particularly among Gen Z and millennials,
Right.
are having a major impact on how money is flowing and where it's going.
It's a generational shift.
Exactly.
Yeah.
And what's particularly interesting is this clear generational divide in terms of banking preferences.
Oh, how so?
Well, the older generations often still place a high value on that personal touch.
Boy, they.
They want to interact with a human being,
Right.
either at a physical branch or over the phone.
Uh-huh.
They like that sense of security and familiarity.
Right.
But younger customers, those digital natives that we talked about,
Yeah.
they prioritize the convenience and efficiency of digital channels.
They want to do everything on their phones.
Exactly. The report actually uses an X-shaped generational growth curve for payments to illustrate this.
Interesting. What does that show?
Well, it shows the rise of digital payments and the decline of credit card usage among Gen Z.
Okay.
And the statistics are pretty striking. It says that 79% of baby boomers still prefer using those physical credit cards,
Wow.
while only 28% of Gen Z.
So it's almost a complete reversal.
It is. And then on the flip side, 79% of Gen Z are using digital wallets compared to only 28% of baby boomers.
That's a huge difference.
It is. And it really highlights that shift in how different generations are approaching their finances.
And with Gen Z set to become the largest global age group by 2025,
Right.
their preferences are really going to shape the future of the financial landscape.
Absolutely. And it's not just about payment methods.
What else is there?
It extends to their saving habits as well.
Oh, interesting.
The research suggests that Gen Z is not only digitally savvy, but they're also financially aware.
Okay.
A significant portion of them are already actively saving, and they see saving as a really important part of their future.
That's encouraging.
It is,
Mhm.
and the report gives a great example of this. They talk about a company in Vietnam called Cake.
Okay.
They specifically targeted Gen Z with their offerings, and they managed to acquire nearly 5 million customers in less than 4 years.
Wow, that's incredible.
It is, and they did it profitably.
So they're really tapping into something.
They are. They're showing that you can appeal to this younger generation and build a successful business by understanding their digital-first mindset and offering services that are relevant and user-friendly.
That's a great takeaway.
Now, the report also points out that this growth in digital payments isn't just happening in developed countries.
Right.
It's a global phenomenon,
I can see that.
and many of the largest real-time payments markets are actually located in emerging economies.
Oh, that's interesting.
It is. It suggests that there's a huge and rapidly expanding opportunity in these markets.
Because they're adopting digital payments even faster than some developed countries.
Exactly. In many cases, they're leapfrogging traditional banking infrastructure altogether.
And going straight to digital.
Exactly.
Yeah.
Which creates a lot of opportunities for those fintech companies that have the agility to enter these markets and cater to those digitally native populations.
That's where the real growth is.
The report highlights MacH Bank in Latin America as a great example of this.
What do they do?
Well, they're a digital wallet that's successfully banking the underbanked.
Okay.
And they've done it by really focusing on scale and speed.
How so?
While they've leveraged Mambu's cloud core banking solution, which has allowed them to integrate rapidly and keep their costs down.
So they can scale quickly and offer their services affordably.
Exactly. And their customer acquisition numbers are pretty impressive.
Like what?
They've acquired over 2.8 million new customers just in the last year.
That's a lot of new customers.
It is. And they're processing over 20 million transactions every day.
Wow, that's a lot of activity.
It is. It really shows the power of this digital-first approach.
It does.
We also see Revolut making significant inroads in Portugal.
Oh, yeah, they've been doing well there.
They have. They've built a really substantial customer base, and they're competing head-to-head with the major banks, despite having a much shorter history in the market.
That's impressive.
It is. And the report points out that neobanks tend to be particularly successful in countries where there's a larger proportion of people who are underbanked.
Oh, that makes sense.
It does.
Yeah.
They're not just fighting for a slice of the existing pie.
Right.
They're actually creating new markets by bringing financial services to people who were previously excluded.
They're expanding the pie.
Exactly. And Time in South Africa is another great example of this.
Okay, tell me about them.
Well, they decided to focus on savings and transactional banking first
Okay.
because they recognized that there was a lower savings rate in the region.
Mm-hmm.
So they wanted to help people build that habit.
That's smart.
And they came up with a really innovative partnership strategy.
What did they do?
They set up physical kiosks in partnership with major retailers like Pick and Pay.
Oh, interesting.
And this helped them to bridge the digital divide and build trust with a wider customer base.
So they're combining the physical and the digital.
Exactly. And it's been a really successful approach. They've grown incredibly fast.
Have they?
Yeah, they reached profitability in under 4 years, and they've even achieved unicorn status.
Wow. So they're valued at over $1 billion.
That's right. The report emphasizes the crucial role that technology plays in all of this,
Right.
especially the speed at which you can make those data-driven decisions.
Mm-hmm.
That's really key to gaining a competitive advantage through tailored personalization.
Because you can understand your customers better and offer them exactly what they need.
Exactly. You need to be able to analyze that customer data quickly and translate those insights into personalized offers and services.
It's about moving away from that generic one-size-fits-all approach.
Right, and cultivating those more meaningful and relevant relationships with your customers.
It's about building loyalty.
The report also found that the leading mobile banking providers are acquiring significantly more account customers,
Oh, really?
and they're growing their accounts business much faster than their peers.
So the mobile experience is really crucial,
It is. It's often the primary way that people are interacting with their bank.
especially for those younger generations.
Exactly. So having a seamless and intuitive and feature-rich mobile experience is absolutely essential.
It's not just a nice to have anymore.
It's table stakes.
And the fact that neobanks and fintechs often offer higher interest rates on deposits than traditional banks doesn't hurt either.
Right, that can definitely be a factor in their customer growth.
It's a good incentive.
Now, despite all this emphasis on technology and the rise of these new players, the report brings us back to the enduring importance of relationships and achieving what they call account primacy. They explain that even with all the regulatory burdens and the tight margins, deposit taking is still a really vital activity.
Why is that?
Well, it's about more than just managing funds.
Okay.
It's about establishing that direct connection with the customer.
That relationship.
Exactly. And that relationship creates opportunities to cross-sell other financial products and services.
I see.
So you can increase the long-term value of that customer.
Makes sense.
The ultimate goal for any financial institution is to become the customer's primary bank account.
Right, the one they use for everything.
Exactly. And the report gives some really interesting insights into how fintechs are competing for those deposits.
Oh, how are they doing that?
Well, they're focusing on things like competitive interest rates low or no fees,
Yeah.
digital convenience, and forming those strategic partnerships across various ecosystems that we talked about.
Right.
So we see examples like Time with their loyalty programs,
Uh-huh.
Cake with their focus on speed and security, and Chocolate Finance, which has this really interesting feature that automatically manages your spare cash.
Oh, cool.
Yeah, and Magic Bank, which offers all its services completely free of charge.
Wow, so they're really pulling out all the stops.
They are. They're really trying to differentiate themselves.
Makes sense.
In contrast, traditional banks are often focusing on leveraging their existing scale and their established brands to try to retain their customers,
So they're playing defense.
in a way.
Yeah.
But the report acknowledges that they're having a hard time attracting those younger customers.
Who are looking for higher returns and that digital-first experience.
Exactly. And we're seeing a growing trend of mergers and acquisitions in the banking and payments sector.
Oh, really?
Yeah. For example, Mambu recently acquired a company called Numeral to boost their payment capabilities.
So they're trying to stay ahead of the curve.
They are. And the report really makes the point that fintechs have proven that you can have a digital-first approach and still achieve scale and growth.
You're right.
And the markets are rewarding them for it.
They're seeing the value.
They are. The report highlights Nubank as a great example of that.
What have they done?
Well, they've been able to launch a huge number of new features and solutions really rapidly because of their agile technology platform.
So they're really innovating.
They are. But the report also sounds a note of caution.
Okay, about what?
They say that you can't just rely on offering high interest rates to attract deposits,
Right.
because that can become really expensive, and it often leads to customers who are just chasing the best rate.
So they're not really loyal.
Exactly.
Yeah.
They'll jump ship as soon as a better offer comes along.
I see.
So the key is to use technology to create that deep personalization that we talked about
Okay.
and build those stronger, more lasting relationships with your customers.
It's about more than just the numbers.
Exactly. It's about understanding their needs and providing them with a truly valuable experience.
I agree.
Now, the report suggests that the next phase of this evolution is going to involve more collaboration between banks and fintechs,
Oh, interesting.
rather than just straight-up competition.
So more of a cooperative approach.
Exactly. And it makes sense because each type of institution brings its own strengths to the table.
Right.
Traditional banks have that scale, those established customer bases, and a long history of building trust, while fintechs are agile and innovative, and they have that deep expertise in creating those seamless digital experiences.
Right, so it's a win-win.
Exactly.
Yeah.
By working together, they can leverage each other's strengths and create even greater value for their customers.
That's a really interesting idea.
The report actually quotes a European banking CIO.
Oh, what do they say?
Well, they envision a future where customers will be able to access deposit products from a variety of different providers directly through their main banking interface.
Wow, so it's like a marketplace for financial products.
In a way. And it points to a future where banking and financial services become much more integrated into our daily lives.
Through embedded finance.
Exactly.
Yeah.
Where you might be interacting with all sorts of different financial providers without even realizing it.
That's pretty cool.
And it's all happening seamlessly behind the scenes through a single convenient interface.
That's the future.
And we're already seeing examples of this kind of deposit cross-selling working in the real world.
Like what?
Well, there's a company in Germany called Raisin.
Okay.
They're an online platform that connects savers with banks that are offering competitive interest rates.
Oh, interesting.
And they've become really profitable.
So they're proving that the model works.
They are. They're showing that there's a real demand for this kind of service.
It makes sense.
It does. And for fintechs that are operating in those growth markets that we talked about,
Right.
strategic partnerships are absolutely crucial.
Why is that?
Well, they need to build trust and reach those new customer segments.
Okay.
And partnering with established players can really help them to do that.
It gives them instant credibility.
Exactly. The report points to Time's partnerships with Pick and Pay and the Gokongwei Group as a prime example of this.
So they're leveraging those existing loyalty programs.
Exactly. And it's a really smart way to acquire new customers and build that trust quickly.
It's a shortcut to success.
Now, the report does acknowledge that a fully functional open banking ecosystem where data and services can flow freely between institutions
Right.
is still a ways off.
It's a work in progress.
It is. And they point out that these partnerships require careful management and technical integration.
It's not as simple as just shaking hands and agreeing to work together.
Right. It takes a lot of effort to make it work smoothly.
It does.
And this brings us to the critical role of data,
Okay.
which the report describes as the new gold.
Interesting.
And they talk about the emergence of autonomous banking.
Oh, wow. Tell me more about that.
Well, the report emphasizes that successful partnerships and truly personalized services
Right.
rely on having a really strong technology backbone that can effectively organize and interpret all of that shared data.
So you need to be able to make sense of all that information.
Exactly. The ability to manage, analyze, and extract insights from data is becoming a core competitive advantage for financial institutions.
Because it allows you to understand your customers on a much deeper level.
Right, and to personalize those offers and services and to streamline your internal operations.
It's about efficiency and personalization.
Exactly.
Okay.
Now, the report points out this interesting paradox.
What's that?
Traditional banks often have huge amounts of customer data,
Right.
but they've historically been slower than fintechs at actually extracting meaningful value from it.
So they're sitting on a gold mine, but they don't know how to dig it up.
That's a good way to put it.
It's ironic.
It is.
Yes.
And this really highlights the need for a secure, borderless, and easily accessible banking core for effective data management,
Right.
especially when you consider that data growth is projected to triple in the next few years.
Wow, that's a lot of data.
It is. It's like having a central intelligence system for your entire financial operation.
That's a good analogy.
And looking ahead, the report talks about the emerging potential of autonomous banking systems.
What are those?
Well, they could potentially automate a lot of those front office tasks and decisions.
So like a self-driving bank.
In a way.
Yeah.
And this makes having a robust and well-organized data repository just as critical for financial stability and success in the 21st century as those central bank gold reserves were in the 20th century.
It's the new gold standard.
Exactly. The report really drives home the point that technology is absolutely fundamental to the future success of any institution that wants to be involved in taking deposits.
It's the foundation.
It is, and they say that banks need to learn to do more with less.
Like fintechs.
Exactly. They need to become more efficient and more agile.
It's the only way to compete.
The report concludes by outlining 6 core values that they believe are essential for both banks and fintechs to thrive in this evolving landscape and achieve that coveted account primacy.
Okay, what are they?
Well, the first one is autonomous.
Meaning, what was it meant?
It means being driven by that borderless core technology that we talked about, which can lead to significant enterprise value, like reducing IT costs.
Okay, that makes sense.
The second one is flexible, which means being able to enable highly personalized account management and efficient customer acquisition like Time has done so successfully.
Right.
The third core value is versatile, which is about facilitating real-time product management and improving customer retention even in a challenging market.
Okay.
The fourth one is agile, which means fostering a culture of innovation and rapid product development like Nubank has done with their frequent release of new features.
That's important.
It is the fifth core value,